Good morning, everyone. I'd like to call the December meeting of FASAC to order. Welcome to council and board members and all of those of you who are joining us. Um, all FASAC members who are attending the meeting today have joined, and a listing of the FASAC members with their affiliations is available on the FASB website. For the FASAC members, as a reminder, please keep your audio on mute unless you're speaking. If you'd like to speak, please use the raise hand feature, and I will call on you when it's your turn. If you have a point that you'd like to follow up that's germane to the topic we're talking about immediately, use the raise hand feature as always. That would be great. So we have three topics on the agenda for today. We're going to start with highlights on hot topics from the FASB, SEC, PCAOB, and AICPA. Then we'll begin our first topic, which will be a breakout group, risk management and hedge accounting, um, followed by a full group discussion of that after lunch. Uh, do lunch at 12 o'clock. After that, we reconvene at 1 to begin our discussion on risk management and hedge accounting. Again, we'll conclude the meeting with discussion of the implementation of recent standards, including crypto assets and the use of resulting information. We'll wrap up around 2:45. After the public session, we're going to take a few minutes to thank and recognize the 12 council members who will conclude their terms this year, and as this will be their last FASAC meetings. And I also want to thank all of you for the assistance of helping us to identify new members to be strong contributors to our discussions in the future, and those should be announced within the next few weeks or so. So to start it off, I'm going to turn it over to Rich Jones, highlights the FASB chair for highlights on recent FASB activities.
Great. Thanks, Mike, and good morning, everyone. Please find a copy of the third quarter chair report in your materials. I did want to spend a few minutes to update you on our activity. During the third quarter and through today's meeting, the FASB issued final standards related to accounting for and disclosure of software costs, derivative scope refinements, application of CECL to trade receivables, the accounting for purchased financial assets, and hedge accounting improvements. We also issued an exposure draft related to accounting for paid-in-kind dividends on preferred stock. In addition, up through today's meeting, the board has completed redeliberations and voted to issue final ASUs later this year or early next year on our projects on accounting for environmental credit programs, accounting for government grants, codification improvements, interim reporting, and accounting for debt exchanges. When you look at our technical agenda today, you'll notice that of the 10 projects on our technical agenda, 5 have been voted to proceed to final standards, 1 is in redeliberations, and 4 are in initial deliberations. We're continuing to use the research agenda to gather additional input for our board as it relates to future projects. This includes bringing the feedback on our 2025 agenda outreach ITC back to the board, and we've already added 2 projects on our agenda as a result of that process. Through the end of this year and into next year, we will be bringing the remaining 70 items that we walked FASAC through, I think, just at the last meeting, back to our board for future standard setting decisions. The EITF and the Private Company Council, as well as our normal receipt of agenda requests, will also continue to provide the board items to consider adding to our technical agenda. And we look forward to continuing to discuss these issues with FASAC in future meetings. We're also continuing the work on the PIR related to the current expected credit losses standard and recently issued the final lease post-implementation review report. The lease PIR process proved extremely valuable to us here at the FASB by not only providing us input that relates to the standard, but also opportunities to identify ways to improve the standard setting process. In addition, during the third quarter, we issued the 5th annual investor outreach report, which highlights over 2,100 investor interactions over the last 5 years. And on behalf of my colleagues here at the FASB, I would like to thank FASAC for their continued support. I know I went through a laundry list of items that certainly sound familiar to FASAC at this point in time, because I think we've discussed just about every single one of those with you at least one time. So I appreciate your input and look forward to engaging with you through the coming year. Mike, back to you.
Thank you. The agenda outreach time is always an interesting one, and the 2,100 investor points of contact are very impressive. Any questions for Rich? Okay, if not, we'll turn it over to Gaurav Harandani, SEC Associate Chief Accountant, and he'll give us an update on SEC events.
Thank you, Mike. As always, truly a pleasure to be here today. I do want to take a moment to just briefly thank all the council members departing for their significant contributions and dedication to the council, and also to thank you, Mike, for your leadership as chair of FASAC. I know it's your last meeting. We look forward to working with Dave as he takes over the reins. I will start with my disclaimer that my comments and any views I express today are provided in my official capacity at the Commission's Office of the Chief Accountant, but do not necessarily reflect the views of the Commission, the Commissioners, or other members of the staff. So as many of you are aware, from October 1st through mid-November, our agency experienced temporary closure due to the broader government shutdown. And as the staff have returned, we've been diligently working to address various pending matters. So consequently, it's been back to business as usual for us, and so my updates are fairly limited for this meeting. As you may recall, at our last FASAC meeting in early September, I mentioned the Commission had released the 2025 Spring Regulatory Agenda, which covered a number of rule proposals to reduce compliance burdens and facilitate capital formation, including by simplifying pathways for raising capital and investor access to private businesses. One of the items on that agenda covers potential rule proposals related to the offer and sale of crypto assets to help clarify the regulatory framework for crypto assets and really provide greater clarity to the markets. So to that end, in late September, the SEC and the Commodity Futures and Traders Commission, or the CFTC, held a joint roundtable to harmonize our efforts between the two regulatory agencies as it relates to regulating crypto assets, as well as other topics that are common between the two agencies. Separately, more recently, I will note that Chair Paul Atkins has expressed that the SEC will prioritize a rulemaking proposal that will consider quarterly versus semi-annual reporting for registrants. I know that's been talked about quite a bit in media as well. And then lastly, in terms of commission updates, later this week on December 4th, the SEC's Investor Advisory Committee will host a meeting to discuss, among other topics, potential recommendations to the Commission regarding the disclosure of AI's impact on a registrant's operations. And so the committee will meet to discuss that, as well as tokenization of equity securities and how that may work within our existing regulations. So a lot of interesting topics, and would encourage anyone interested in the latest updates on these or other matters to make sure to visit the sec.gov website for more information. And then, finally, we like to end these updates with any relevant accounting consultation trends. So I'll just, continue to reiterate, we continue to receive questions on accounting for novel crypto market activities, and those have continued to include whether certain stablecoin holdings may be classified as cash equivalents, as well as the revenue recognition related to crypto asset staking activities. We've also received questions related to investments in artificial intelligence that have covered topics such as consolidation, leasing, and R&D funding arrangements. And more recently, we've received a variety of questions that don't necessarily indicate a specific trend, but they include topics such as evaluating whether certain collateralized loan obligations are considered securities versus receivables, questions on tax-related accounting policies, and continued questions related to determining the accounting acquirer or accounting spinner in a transaction. So with that, happy to take any questions, but also very much looking forward to our discussion today.
Thank you, Gaurav. Any questions? Okay, if not, I'd like to turn it over to Heather Josem, Assistant Chief Auditor, PCAOB.
Good morning, everyone. It's a pleasure to be here as always. Before I begin, I need to provide our standard disclaimer that the views expressed are offered in my capacity as staff of the PCAOB's Office of the Chief Auditor, but they are my own and do not necessarily reflect the views of the board as a whole, any individual board members, or other PCAOB staff. Today, I'll share some highlights of recent PCAOB activities, and I'll begin with PCAOB activities related to standard setting. The PCAOB released a board policy statement to assist auditors in implementing new paragraph 10 Cap A of Auditing Standard 1105 Audit Evidence. The PCAOB adopted paragraph 10 Cap A and other amendments to AS 1105 on June 12, 2024. The amendments become effective for audits of financial statements for fiscal years beginning on or after December 15, 2025. Paragraph 10 Cap A requires auditors to evaluate the reliability of external electronic information provided by the company by A, obtaining an understanding of the source and of the company's process for receiving, maintaining, and processing the information, and B, testing the information or the relevant controls. Paragraph 10 Cap A does not prescribe the nature, timing, or extent of procedures. Instead, the requirements are principles-based and scalable. During the rulemaking process, commenters requested implementation guidance on paragraph 10 Cap A, particularly with respect to paragraph 10 Cap A B's testing requirements. In approving the amendments, the SEC encouraged the PCAOB to issue such guidance. The board policy statement provides information relevant to the implementation of paragraph 10 Cap A B, describing certain circumstances in which the board will not treat the absence of separate testing under paragraph 10 Cap A B as noncompliance with PCAOB auditing standards. Following the release of the board policy statement, the PCAOB published staff guidance providing illustrative examples of the application of paragraph 10 Cap A that can help audit firms implement the paragraph 10 Cap A requirements. The examples should be read in conjunction with the new requirements, the adopting release, and the board policy statement. Next, turning to recent publications of the PCAOB. In September and October, the PCAOB issued 3 new editions of the Data Point series. Data points present concise, data-driven insights relevant to audits. They offer neutral, factual information drawn from PCAOB datasets and other available sources. The 3 new editions of Data Points include Who Audits Emerging Growth Companies, Auditors of SPACs at IPO, and Financial Statements and Auditor Turnover. Notably, the Financial Statements and Auditor Turnover edition presents that from 2005 to 2024, Big R financial restatements occurred at a rate of around 3% per year. On average, just under 30% of these restatements followed an auditor change in the previous year. As a point of reference, the average annual auditor change rate across the broader population, which includes companies without Big R restatements, was 11%. Next, I'll highlight the topics discussed at the recent Investor Advisory Group and Standards and Emerging Issues Advisory Group meetings. The September 25th Investor Advisory Group meeting included presentations on private market valuations, internal controls of financial reporting, decision useful critical audit matters, and an update on foreign inspections. The November 5th Standards and Emerging Issues Advisory Group meeting focused on technology, specifically artificial intelligence and cryptocurrency. Lastly, I'll share an overview of 2 recent conferences and the 17th International Institute on Audit Regulation. In September, the PCAOB, in partnership with Management Science, held its 2025 Registered Reports Conference. The research proposals presented at the conference addressed 3 broader themes: the use of technology in the audit market structure and incentives, and critical audit and financial reporting processes. In October, the PCAOB, in conjunction with the Accounting Review, held its 12th Annual Conference on Auditing and Capital Markets. The research papers presented addressed auditing and management disclosures, private equity investment in auditing firms, the labor market for auditors, auditor independence, and the impact of regulation on non-capital market audits. Also in October, the PCAOB held the 2025 International Institute on Audit Regulation. Panel discussions covered topics such as emerging opportunities and challenges in auditor oversight, technology and audit regulation, the intersection of private equity investment audits and audit regulation, and the latest insights from PCAOB inspections. All of these resources that I've mentioned are available on the PCAOB website. That concludes my prepared remarks. I'm happy to answer any questions you may have.
Thank you, Heather. Any questions? Okay, if not, I'd like to turn it over to Dawn Brenner to give us an update, who's the chair of the peer review board, for a brief update on activities at the AICPA.
Oh, sorry, I don't have my camera on. I'm not feeling particularly good this morning, but just as a background, we did pass the Emerging Areas Framework at our November board meeting, which is to address emerging areas, obviously, and we also deferred the exposure draft on APS, alternative practice structures, because we got a lot of comments on that. And so the Standards Task Force is going to be looking at that, and we'll probably come back to the board next February. The original exposure draft proposed that any CPA firms or any peer review firms with APAS be administered by the NPRC. And so that is probably going to go forward, but is still being considered due to the negative comments on that. And that is pretty much about it. Thank you.
Well, we certainly appreciate your hanging in there when you're not feeling well, Dawn, and hope you feel better soon.
Thank you.
Any questions for Dawn? Okay, if not, we'll move on to our first topic, risk management and hedge accounting. I'll turn it over to Erin Cahill, FASB Supervising Project Manager, who will introduce this topic. Erin is accompanied by FASB Practice Fellows Aliana Armstrong, Michael DeMarco, and Brandon Brown, who will be in the breakout groups later today. So turn it over to you, Erin.
Thanks, Mike, and good morning, everyone. I want to start off by saying thank you to FASAC members for their preparation for and participation in the discussion on this topic. While we appreciate that hedge accounting may be somewhat stigmatized as being challenging to apply and to understand, we believe that risk management is relevant to virtually all organizations. So we welcome feedback from all as we are exploring ways to more accurately reflect risk management activities in financial statements. To touch briefly on the objective of the session today, FASAC members will be asked to describe their experience or perhaps lack of experience with hedge accounting guidance and provide suggestions on how the board should consider improving the guidance to make it more approachable and more representative of how entities manage their risks. This will include a discussion of whether the board should continue to amend the existing model to make it more flexible, or whether the board should develop a new model to replace the existing model. We'll also ask for feedback on what types of risk management activities hedge accounting should reflect, and how the decision usefulness of disclosures about risk management and hedging activities could be improved. To help frame the conversation today, I'll provide a brief background on the hedge accounting guidance, which is meant to summarize the background in the materials provided in connection with today's meeting. So as many of you may know, much of the derivatives and hedge accounting guidance that exists today originated in FAS 133, which was issued in 1998. Before 133 was issued, derivatives were not always required to be recognized on balance sheet. So when all derivatives were brought on book, hedge accounting was meant to address differences in the measurement and timing of earnings recognition between hedged items that were often measured at amortized cost and the associated derivatives that were being marked to market through earnings. And at the time, the derivatives market was relatively nascent. But the hedge accounting model introduced by 133 was intended to be a stopgap measure while the board pursued a vision at the time of having all financial instruments measured at fair value. The thought was that achieving that objective would have eliminated much of the need for hedge accounting. Because the board thought that the hedge accounting guidance would be this temporary bridge, it compromised on some of its conceptual beliefs to allow it. But in doing so, the board wanted hedge accounting, the application of hedge accounting to be limited. And hedge accounting was viewed as a privilege, not a right, and it was designed to be applied only to a narrow set of facts and circumstances, rather than more broadly reflect the economics of risk management. So that's all to say, the fact that hedge accounting oftentimes does not convey the economic of risk management activities reflects its intended design. From 1998 to current day, the board has continued to amend the guidance to make it more operable. Hedging has consistently been on the board's agenda for the past 25 years. And we issued ASU 2025-09 last week as the latest in our updates to improve hedge accounting. 2017 did mark a shift in the board's thinking on hedging. It was in that year, in 2017, the board issued 2017-12. That was an extensive set of targeted improvements, and the objective was different from this past objective of FAS 133. Whereas 133 was meant to be this temporary limited fix to recognition and measurement mismatches, 2017-12 was meant to facilitate financial reporting that more closely reflected an entity's risk management activities. So now the modeling gap is somewhat at odds with itself in that it was designed to be applied to this narrow set of fact patterns, but more recently has been updated to be representative of risk management activities in certain circumstances. So not surprisingly, in the 2025 agenda consultation, the board received relatively consistent feedback that hedge accounting is in need of improvement because it's complex and does not accurately reflect common risk management strategies. And that results in entities using non-GAAP metrics to convey the economics of their risk management activities, or sometimes entities forego using derivatives for risk management altogether. 2025 agenda consultation respondents provided numerous suggested solutions. Some recommended a holistic reconsideration of the hedge accounting model, while others suggested retaining the core model but making the pillars more flexible, such that common risk management strategies would qualify for hedge accounting. And in addition to recommending either of those approaches, many stakeholders encouraged the board to take targeted improvements in the near term and make those while also pursuing a broader project. The staff has analyzed all the feedback that we received in the 2025 agenda consultation and through other forums over the past 5+ years in the form of agenda requests, and is seeking FASAC's input on a potential broad project to modernize hedge accounting. And the staff has identified 2 potential paths to accomplish that. Path 1 would retain the mechanics of the current model, but would allow broader application. So under this path, the recognition and measurement mechanics of the current model would largely be retained. So you would still have your fair value, your cash flow, your net investment hedging, but the core pillars would be made more flexible so that more economic hedging activities would qualify for hedge accounting. However, under this model, it would not permit net hedging, so net assets and liabilities or net revenues and expenses. Under this model, you would still have to designate hedges on a gross basis, which may in some circumstances not align with how risk management and treasury functions operate. But under this model, or under this path, I should say, the potential amendments that the staff could research would include expanding eligible hedge transactions and hedging instruments, simplifying testing and documentation, and enhancing disclosures to potentially simplify them and make them more decision useful. Path 2 would be a more comprehensive change than path 1. Under this path, the board could converge to a single model. So instead of having those 3 models of fair value, cash flow, net investment, the board could decide to have one recognition and measurement model. And it could make holistic changes to the pillars. The objective of hedge accounting could be revised to align with entity-wide risk management objectives. And under this model, hedging net asset and liability positions or net revenue and expense positions could be permitted. Disclosures would also be reassessed under this path to align with this new overall model that would be representative of net position hedging. And just to be clear, this would not be convergence with the IASB's model that you might know as dynamic risk management or DRM, but the objective of this path would be similar. Just highlighting one of the differences that we would see is that the IASB's project is maybe more specific to interest rate risks and bank hedging. We would envision under either path, the amendments that the board would make would consider all different types of risks. So commodity risk, credit risk, interest rate risk, any risks that entities do manage, as well as not be industry specific. So like I said, any type of industry that uses derivatives to manage risk, we would hope would benefit from a potential broad project. So to summarize, Path one would be a home renovation where we're gutting the interior, but keeping the foundation of the house, taking down some load-bearing walls and putting up some structural beams, if you will. Path two would be excavating the foundation and starting relatively fresh. In the breakout groups, when we ask the question seeking feedback on the paths, we are really interested in understanding how far we need to go to make meaningful changes in the area so we don't have to keep amending the model for the next 25 years as we have for the past 25 years. So the complete list of questions that we have for FASAC members are on page 9 and 10 of the materials, but I'll go ahead and conclude and open it up to any FASAC members who may have questions before the breakout groups and kick it back to Mike.
Great. Thanks, Aaron. That was a great summary of a complex topic over a long period of time. So that was helpful. So any questions or any observations from board members about this topic before we go into the breakout? Looks like, Richard.
Yeah, I just had a quick question about this idea that 133 was originally a stopgap measure until financial instruments were measured at fair value. And my question is, like, a lot of hedging is done for revenues and expenses that are denominated in foreign currencies or commodity exposures, things of that nature. It would never have solved that problem, right? If I understand. I'm just trying to get a sense for whether that was always a problem that was going to exist under 133.
That probably would still be the case, yes.
Yeah.
Okay. Other questions, comments? Okay. Thank you. So the breakout discussions will start now. The breakout groups are private meetings. They will not be recorded or live streamed. Those listening to the live stream may rejoin us when we convene at 1 p.m. The discussion questions that Aaron referenced are on page 9 of attachment 2. Copy of the breakout group participants is in the meeting materials, but during the brief break, members will be automatically moved to their assigned breakout groups, so you don't need to worry about anything there. After our breakout sessions, there'll be a 1-hour break before we reconvene as a full group. As always, for each of the breakout groups, there's 2 co-leaders who will provide a summary of key takeaways when we reconvene with the full council. Those breakout group rooms will remain open throughout the break for the co-leaders, so they can get together on what points they want to raise, but meeting participants will automatically be moved to the main session when we resume as a full group. Throughout the meeting, we recommend that you stay connected to the meeting. You can turn off your video and audio during the break. So any questions before we close out our live stream and meeting participants are moved to the breakout? Welcome back, everyone. We're going to pick up and talk about the results of the breakout group around risk management and hedge accounting. I think this is one of those sessions where if we had been in person, the conversations might have traveled into lunchtime as well, because we had, at least in my group, we had very spirited discussions. So I'm going to start with Group A, Adam and Shripad, and we've asked sort of the group leaders to sort of start with question 1, and then 2, 3, and 4 will group together. So let's start with Group A on question 1.
Yeah, Mike, and I'm sorry, we're just question 1 at this point. Is that correct?
That's correct. Yep.
Yeah. Okay. So Shripad and I got us going. Maybe the first thing to note is the group was comprised primarily of corporates. There were no banks, no financial institutions represented in the group, and so we're kind of interested to see how some of the thoughts in this group compared elsewhere. But in terms of the reasons that might lead preparers not to apply hedge accounting, some of it probably commonplace, but the complexity, the costliness of applying the standard is daunting in a variety of cases, and these are for maybe more prevalent in situations where folks are mitigating particular risks, particular strategies. Maybe it's not necessarily a system-wide or an enterprise-wide hedging shop. And so if you get into a hedge with a large notional, just the risk of error and unintended consequences is problematic. There were a couple of points there, just as some context. I think we've seen this, I certainly seen it in my practice, that companies often rely on third-party hedge accounting specialists. So it's not necessarily an economic hedging expert, but the actual accounting expert to help get the accounting right. And that's seen as a prudent step across a wide variety of different sizes and types of companies. There was a mention also of an academic study that came out recently. So the board issued a standard in 2017 that made some simplifications to hedge accounting. And so as we understand it, that academic study indicated that once the accounting, I'll say simplified marginally, there was actually an uptick in true economic hedging, and therefore some of the accounting as well. But folks are actually choosing not to hedge in some cases just because of the difficulties in the standard was sort of the takeaway of that study. The other thing that was mentioned, and this is just a separate, I suppose, driver, is there may be some strategic reasons that companies just choose not to hedge. So it's not necessarily the difficulty in the accounting, but there may just be a decision to, I'll say, source commodities or materials at market, sell them at market, and for a variety of reasons, that's the strategic direction of the firm, just not to engage in steps to manage risk associated with the pricing of some of those commodities. So I'll say the complexity was probably the bigger driver of the discussion around reluctance, but also some strategic decisions in some cases just not to do it also came up. So Shripad, did I miss anything there?
No, I think you covered it. I think the key point was, from a corporate's perspective, non-banks and financial institutions, like Adam mentioned, the use of hedging is also limited in terms of what is being hedged, interest rates, FX for that matter. And in certain sectors, it would be like commodity derivatives, right? But largely, there's a limited use of these hedges outside of financial institutions overall. That was the sense too. But yeah, I think Adam covered the rest of it.
Okay, great. Brandon and John Ball, what did your group discuss as it relates to question 1?
Thanks, Michael. I mean, pretty similar to group 1 overall. We did have the benefit, though, of having banks, financial institutions represented, including John Ball, that I'm assuming will add on to my commentary. We talked about that the use of derivatives and the use of hedge accounting really depends on the industry and the nature of the risk. So I think sometimes you could say, well, banking and insurance, well, that's only certain companies in certain industry, but they are a very large user of hedging as well as macro hedging. And the companies that may want to apply more hedge accounting, but can't qualify for certain strategies under the current framework. So you got companies that would like to apply hedge accounting, but the framework doesn't accommodate. But then in other industries, you have companies that have abandoned attempting to apply hedge accounting due to complexity, energy, and commodities that have gotten comfortable with non-GAAP measures in lieu of applying hedge accounting. And we've seen some consumer companies that would like to apply hedge accounting, but have just, avoided it due to complexity. If I could call on Jan, I don't know if I gave you a heads up. I tried to give you a last minute heads up. It's a little harder virtually. But you had some comments around the stigma of hedge accounting and what you've observed from the avoidance perspective as well.
Yes, thank you, John Ball. Thanks for the heads up. I was commenting in my breakout sessions. I know there have been multiple attempts by the board in the past to try to simplify the hedge accounting model, but the stigma is definitely out there. So when I talk to our clientele, which are primarily private company and small issuer clients, once they heard the word hedge accounting, they all just sort of take a gasp and backed away because they just don't want to deal with the complexities and the nuances and the many of the criteria they have to apply in order to apply hedge accounting. So they'd rather just take the easier way out and just do the economic hedge and deal with the fair value aspect of the instruments.
John Bull, you have anything else to add? I'm sure when we get to question 2, you'll have plenty to add.
Well, so I think Brandon, you and Jan covered it, but just to bring it home, to the way the question was phrased, we do not. I mean, we do not apply hedge accounting to economic hedges with a lot of things in banking, right? And as Jan said, lots of small private companies, 99% of the time, no one applies hedge accounting, even those that have the need to do risk management around interest rates, commodity, and similar market risk because of the complexity and the burden that comes with it. Banks, do economic hedging for things like MSRs, mortgage servicing rights, structured notes, commodities, risk transfer agreements for loans, et cetera, et cetera. I can give you a really long list. They're economic, but we can't get hedge accounting for a variety of reasons. But it comes down to inability to prove effectiveness and maintain effectiveness due to variability in the hedging instrument. And if you take loans, for example, we do hedge or buy derivatives at the pool level of loans, right? Which is similar to how you look at loans for reserving for CECL, but you don't have the ability to get hedge accounting, except you go down to the loan by loan level, which is not how you do CECL. So there's misalignment with other accounting as well there. And I could give many more examples, but we had a really good discussion around a lot of places where, you get to economic hedging, but you don't do hedge accounting. Mike, back to you.
Thank you. So Tom and James, what did you discuss as relates to question 1?
Sure. Thanks, Mike. A lot of discussion was very similar. Like group 1, it was corporates, non-financial institutions, though we had users that follow financial institutions, so they gave us a bit of a different perspective, at least around the question 4. Look, I think to synthesize a little bit of what we heard is the types of organizations that don't apply hedge accounting is either, one, they've decided to move away from hedge accounting entirely due to cost, complexity, the lack of an ability to qualify for hedge accounting. Maybe the hedged item's not eligible for hedge accounting. And so they've entirely moved away because there would otherwise be inconsistency in their financial statements. But you do have a group of corporates, at least we think, that do still apply hedge accounting around their treasury function. So maybe they've moved away from a commodity perspective, but they've continued to apply hedge accounting from a treasury perspective around interest rates, or maybe in some circumstances, foreign currency. And there was recognition that over time, the burdens of applying hedge accounting to those types of hedging relationships has gotten better. So the model in some respects has gotten easier to apply, and people are continuing to apply. So they're not electing in certain areas because it's too complex or too costly for a large integrated company, i.e. around commodities, but they are around their treasury function because they feel there's an ability to do that at a lower complexity and lower cost. So I'd say that's a bit of an observation different from the first couple of teams.
Great. Okay, let's move on to question 2. This time we'll start with John Bull and Brandon.
Okay, I'll kick it off here. So, there's a lot that we talked about here. We don't, I think, just in summary, we don't necessarily view this to be binary. The question of, do you prefer paths 1, 2, or a different path? We spoke about a parallel path where it's a good thing that it appears the staff is already, considering the short, medium-term targeted improvements to hedge accounting. That's a great idea, and assuming the board approves going in that direction. I think it would be a good thing to have a separate group within the FASB dedicated to continuing to pursue those targeted improvements in the short, medium term, and then a separate group focused on the longer term, which is where paths 1 and 2 come into play. And again, with paths 1 and 2, we had a lot of discussions around concerns around getting back to a place where the FASB is answering a ton of questions in working through the changes and questions around how much flexibility would you allow management that may lead to unintended consequences. There were discussions around working back from the answer, like what do investors want to see and hear disclosed around exposures and risk management, and then re-engineer that back to what is needed to update the accounting model without really upsetting the entire model for everyone. And so in the end, our thought is a multi-model approach. In addition to the targeted short and medium term, the multi-model approach in the long term that is developed to allow a path for corporates that don't do a lot of hedging or do hedging in very simple ways, versus insurance companies, banks who do really complex models where you could do a model that allows macro hedging and net hedging, et cetera, that could be overly cumbersome for corporates. And so have a multi-model approach that can be developed and have some common elements, but some differences in the way that they apply. So that's broadly what we talked about. For path 1, we believe it still ends up with complexity, and it will still lead to inability to hedge the way banks manage risks, or the way insurance companies manage risks, or commodity companies manage risks. And there's tons of rules around net investment hedge. But it will be consistent with current accounting, right? You don't need to change your systems or learn something new, and it will take less time to make changes. The negatives are what I said: documentation, the ongoing monitoring, compliance, all of that will still need to be maintained, which is one of the reasons a number of small private and public companies are they don't seek hedge accounting, and you have footfalls here and there. So I think the puts and takes and pros and cons with path 1. With path 2, it's really down to wholesale change, right? I mean, it would take a long time. There's concerns around that, perhaps 10 years, and the benefit is, the opposite of what I said about path 1. You can re-engineer this thing where you can get the ability to hedge net risk positions and hedge at the macro level, which is how institutions manage risk. So in the end, I think for us is the different path, which is a parallel path that as I said, seeks to make targeted improvements and then at the same time progress a multi-model approach going forward. Jonathan, I don't know if you want to add anything. I know you had a few views as well.
Yeah, I just, I think you summarized it really well, John Paul. I would say, one thing that we talked about was the fact that risk management and hedge accounting, I think, is inextricably connected to business strategy. And so where we also thought could be a path forward would be around disclosure of the various, types of natural, economic, and accounting hedges, which would provide, I think, a more complete picture to a financial statement user or reader of, a company's exposures.
Yeah, the only thing I would add is at least there was, and this is a very difficult puzzle to solve, is that if you go down this parallel path of of, maintaining the model, making fixes, and exploring whether there's an additional model or framework that could be palatable for banks and insurance companies that have more complex macro hedging is that, there was an observation that you would have to break the fundamentals of the model to get the banks and insurance companies and their users to the result that may make more sense for them. And is that a conceptual problem, right? Are we putting, by putting another model on top, are we putting a Band-Aid on it, but then we have sort of inconsistent frameworks or models that exist? And that's, I think, something for the FASB to think about and in pursuing multiple paths or just going purely down a path to approach. Is it okay to have models that are maybe not conceptually consistent throughout?
Good point. Okay. Tom, James, what'd you guys think about this one?
Yeah, I got this one, Mike. I think relative to path one, I think our group thought that there were probably some, common hedge strategies that today are excluded from the hedge accounting model that could be addressed fairly quickly by the staff. And those included things like hedging held to maturity securities, hedging foreign currency to be issued debt, hedging of business combinations, FX and business combinations, forecasted purchase of bonds, and possibly even fixed or variable rates, dividends on preferreds. And then lastly, I guess we also talked about FX hedging, where people sort of manage it at a group level, and some of the complexities where you can't get hedge accounting if you've got an intervening, different functional currency subsidiary that's sort of in between. We thought that those could be addressed. I think there was less of an interest in revisiting effectiveness. I think there was a general acknowledgement. It's sort of like, when does hot water turn cold? And when have you turned a derivative that's used for hedging? When does it have so much of a, I'll call it, speculative risk included in it that it should no longer qualify for hedge accounting? People thought that might just be, a difficult issue for the board to take on. As far as disclosure, I think there was a general alignment. We'll get to that, I guess, with question 4, that the disclosure probably needs some help, that the existing derivative disclosures where you are hedging isn't really telling the story around how the company is actually executing on their risk management plan, as well as there was some discussion around economic hedges that companies are taking a variety of ways and describing that, often in investor decks or supplemental information that's shared with as part of their earnings releases, etc. I think with path 2, I think our group struggled a little bit around, what would be the full scope of path 2 and what would that look like? What would that entail? And thought it might be difficult. Some of the questions we raised was, are we trying to address accounting, mismatches more broadly for derivatives, beyond derivatives for risk management activities, right? For example, do you want to address, reinsurance contracts? Do you want to address non-derivative instruments that are used as part of risk management activities, etc.? So it was hard for us to sort of wrap our minds around how broad that project would be. And there's a general acknowledgement that it might take a long time to wrestle that down. I also think there was a general belief that, many companies who have employed economic hedges, so they haven't employed the hedging model to date, they might not seek to get hedge accounting, even if you did revise the model, because they figured out a way to deal with it through disclosure. So there's some who question whether it might be worth the effort for many entities who are doing economic hedges. That being said, I think there was definitely sympathy for the large financial institutions who do employ macro hedging, particularly of interest rate risk, for example. And there was a general belief that maybe the FASB could learn more as the ISB continues on their project, which deals with dynamic risk management. I don't think we spent any time on that model per se, but it just might open up some of the considerations that would need to be considered if you wanted to address a model around, macro hedging for financial institutions, which it seemed like was certainly something that the investor base would value. We didn't spend really time around dual pass per se, for whatever that's worth. So maybe I'll stop there and see if Jim or others have anything to add.
No, nothing to add, Tom. You covered it.
Great.
Okay. Shripad, Adam?
Yeah.
Okay.
So, I think a lot of the points have been talked about, based on, what was just been said earlier. But obviously, there were views on both sides, I would say. But I think the balance in terms of part one versus part two was more tilted towards part two. And it was largely from the fact that, it's the fear of the unknown. You really need to know, I think, like what Tom talked about, what the model would look like and how it would work to be able to answer that question, really. Um, Also, I think there was something about, you don't want to bring the whole house down and disrupt the whole process. And also the unknown was the time that may be required to bring a new model into play. So, but if that were even considered, I think, given that we were largely focused on corporates, I think one of the viewpoints was, corporates should still be considered in this whole mix if a new model were to go in place or be considered, because I think there's definitely a lot of differences between the way corporates use hedging versus financials and financial institutions and banks. Um, I think the other key point was, while complex and difficult, the new model really won't change views on companies, so to speak, from a user or investor perspective, right? I think what is available today and what's being accounted for generally works, although complex and not easy to understand. But will it change views? Probably not. There will be more companies who may be able to apply a simpler model, but not really going to change it from a user perspective or investor perspective overall. Uh, and I think the other part was, even if there was a simpler, newer model, there may be some companies who don't apply it. Again, it's more a business decision versus, just going down to applying a simpler hedge accounting model. And from that perspective, there's a cost even for a simpler model, so to speak. So I think generally it was tilted towards one, around disclosures. If there can be more effective disclosures, risk management strategy, and whether they were successful or not. I think things partly may be available in the MD&A today, but I think overall, trying to bring it all together, I think disclosures may be a better path forward.
Okay. Good. So let's move on to question 3, and this time we'll start with Team C. So Tom, James.
Yeah, I'll start. So I think overall we sort of kicked this around. I think the general belief and bias of the group was that hedge accounting should reflect risk management, not necessarily risk transformation. I think there was a fear around risk transformation that entities could be taking speculative positions and not fully showing the underlying economics. I think there was also an acknowledgement that transformation could be really broad. Effectively, it's like taking multiple contractual arrangements or financial instruments and other derivatives, et cetera, and somehow combining those for accounting purposes to try to create some transformed instrument, if you will. And that might be really difficult to deal with as those things change over time, as companies make decisions and close out some of the contracts, and that might transform the nature of what they have. There'd be a lot of issues that you'd have to deal with to actually address that. So given those complexities, I think we all thought that risk management was probably the fundamental tenets of what we've dealt with to date when it's come to hedge accounting, and that we're not necessarily trying to fix all accounting mismatches or cases in which companies, transform underlying risk and want to come up with I'll call it a blended accounting model. It seemed to be a step too far.
Okay. Shripad, Adam.
Yeah, I'll jump in. Maybe two takeaways, at least that I wrote down. The first being that there was some loose consensus around the idea of a scalable model, so that the folks who are addressing specific transactions or very narrow risks, they would probably be in that risk mitigation camp. But as the hedging strategy becomes more central to the nature of the company, then maybe there's room for something that approaches the risk transformation outcome. But again, this is in the context of our corporate discussion. But the idea is that both the recognition and measurement, as well as the disclosures, ought to sort of be fit for purpose or suit the relative complexity or magnitude of the hedging strategy for the entity, right? So we sort of want to have our cake and eat it too. So everybody, I think, generally thought that was a useful principle. But then the next question, well, how do you scale it? Like, what would be the basis on which you would start making some of these cuts? There were different thoughts there. So banks versus corporates was one. Maybe that's a starting point. Hedge strategies focused on specific transactions, right? Purchases and sales of commodities, as opposed to sort of net asset liability positions might be another. And then again, something that was, I guess, asking, well, how relevant is the hedging strategy to revenue or to net income? But different thoughts on how you might go about scaling something from, I'll say, the simpler end of the spectrum to the more complex. Having said all of that, the other takeaway that I had is that there was, I think, some caution, concern about the risk of unintended outcomes, that this just may take too long to get to a fully baked, brand new model on the the transformation end of the spectrum. And so without knowing where that would lead or how long it would take, I think we were generally leaning a little more closely to the what I'll say is the risk mitigation end of the spectrum, right? That just felt a little more concrete and tangible as the group thought about it. So,
Okay. Brandon Jumble.
I don't know if we have really much incremental to what Tom and Adam just summarized. I think it was a good summary. I mean, we spent some time really just talking about how this question really just interacts with question 2 and question 4, and really what the objective is of not only hedge accounting, but the disclosures that are provided to investors around the risk management, using, kind of the term that Tom just used, is you're trying to really tell users and reflect why you're hedging and why you're remaining exposed to certain risks. Because I know, some like to use the term risk selection. I mean, if you're going from a variable instrument and trying to fix it, obviously you're worried about the cash flow variability. You're trying to fix your cash flows, but you're introducing fair value risk when you do that. And so to us, it's more about, what risk you're choosing to manage, what risk you're choosing to mitigate, and providing the relevant information to the users of the financial statements.
Great. Okay. And I recognize with all of these, there's always that overlap between all questions. So I appreciate that's a bit of a challenge as we summarize here. So let's move to question 4 in light of that. Start with Adam and Shripad on this one.
Yeah. I'll kick it off and then let Adam chime in. But again, from a corporate perspective, I think the disclosures today, I think the general consensus in the room was, they do provide what investors and users need. If you look at derivatives, realized versus unrealized or hedges, you do have that already in the underlying asset or liability, which is ultimately what we want to get to in terms of comparing companies. And with the unrealized derivative gains or loss, those are reversed out until realized, which effectively works out to the same thing in terms of hedging. So I think in terms of the disclosures, what users really need is available. Can there be improvements? Absolutely. Like I touched upon a little bit earlier, strategy, risk management, how successful core versus non-core hedging strategies. And I think there was also some discussion around the significance based on notional exposures and the overall exposure for the company. I think at the same time, there was a comment also about you don't want to break the business just by requiring some complex disclosures, especially from a corporate perspective. But a lot of these disclosures have been operationalized already. And the ones that are, using hedge accounting and applying it obviously are the material users anyway. So there are certainly ways to improve it, certainly more focus on risk management and strategies and, those kind of efforts, I think will be useful. But overall, I think they are in place.
Yeah, just one brief point that Shripad touched on, the core versus non-core. I thought the comment was interesting that, again, maybe in a corporate space where the company is sourcing commodities that go into the manufacturing process, they're sold. You might expect to have a very stable hedging strategy period over period over period. Those cash flows are core. The users understand what's going on. Maybe the need for incremental disclosures is low to non-existent. But it's when something new comes in, right? There's a new strategy, there's a new risk where the question may be, well, gee, what are the implications here for the impact on those core activities, right? I need to get my arms around that new thing or that new risk. That if there was a way to design disclosures that reacted to that sort of thing as opposed to the core, that could be useful. So just that one resonated a little with me.
Great. Brandon, Jumbo?
So I think, as I mentioned earlier, we talked about working back from what investors want to see as disclosures, and kind of originated it from there. But when I talk to investors, the biggest thing is they want to be able to forecast, the company's performance, right? And so in doing that, they want to be able to understand how different market conditions could impact financials, how the company is managing the risks around those market conditions. And, if you're hedging as a way to manage those risks, what are those hedges? So brings down to, what, one of our participants had said, which is, perhaps we start to disclose all types of hedges. What are the natural hedges you have? What are the economic hedges you have? And what are the accounting hedges you have, right? But bottom line is, really going back to what are the instruments that you're hedging if there's an accounting hedge? What's the intent of the hedge? How effective is the hedge? And then what are the impacts on your financial statements? What are the line items that are impacted and what are the numbers in terms of impacts on those line items? So that's really broadly how we talked about it. And another angle that came up in our conversation is just pulling way up and saying, what are the risks the company's taken and how is the company managing those risks? And to the extent that, hedges are part of the risk management of the company, again, going back to what are the natural hedges, economic hedges, and the accounting hedges that we have as a company and disclosing that. And then there were questions around different parts of the K and how we already have market risk disclosures and in 305 and 7A and how you bring all that together going forward if we're going to change how we disclose, related to hedge accounting. Brandon, others, anything that I missed?
Nothing for me. Good summary.
Great. Now let's move to Tom and James.
All right, I'll get this one started, and then Tom or others from the group, if they want to chime in, feel free. So a lot of similar views. I would say, though, there was acknowledgement by our group that there's a wide range of good disclosure to bad disclosure, and it didn't necessarily manifest in whether you were applying hedge accounting or you were using economic hedges and therefore then maybe disclosing materials in your earnings materials or investor presentations. That most importantly, from a user perspective, a disclosure perspective, was understanding what risks management is managing and mitigating, and what types of instruments they're using, the notionals of those, how they run off. If you see a runoff schedule, it's easy for users to model those cash flows and those earnings into future periods as they're looking at financials and modeling a company, and that those disclosures, whether they're sitting in the 10Qs, 10Ks because the entity is actually applying hedge accounting or sitting somewhere else. As long as good disclosure was occurring, it didn't necessarily matter whether hedge accounting was being applied. But the acknowledgement was that there is a wide range and that there probably is, and Tom touched on this when he was answering question 2, there probably is some benefit to looking at what we actually have in GAAP required disclosures and whether there's a means to readdress those. I think it's been 10, 15 years, and maybe as part of this effort, looking at a review of exactly what's in the GAAP financials, whether it's economic or accounting hedges, what those disclosures look like.
Yeah,
Tom?
maybe just add on, Jim. I think it was a general acknowledgement that the disclosures we have today in the footnotes really don't tell an adequate story around the risk management strategy it's been taken, and providing some of the information that Jim mentioned around allowing users of financial statements to understand how those things will run off over time. And the last thing I will say is that they're pretty cumbersome disclosures, and so there is definitely a big cost in pulling those together for preparers, with not a lot of benefit right now.
Okay. So covered a lot of ground there. Let me stop and to staff or board members, any follow-up questions, or council members, anything else people want to add? Or did we talk ourselves out in the discussion groups? I don't know.
Just, Michael, one thing I'd add is for regulated industries, and again, a little selfish here, but there's a connectivity here because when, if you pick banking regulators, prudential regulators, et cetera, when they look at, institutions, including insurers, they look at how you manage risk as this huge part of regulation, right? And so designing or adapting an accounting model that creates transparency, not just for investors, but also regulators, and being able to understand and connect the dots around risk management. So, institutions don't have to do separate disclosures for regulators and creating, a whole set of new things for regulators when it comes to, risk management and how those risks are mitigated. I think will be a very important consideration, because that flows into how institutions manage capital and how regulators view things like capital, liquidity, et cetera. So just connectivity to regulation and regulatory oversight is another angle I think we should consider as we go forward.
Yeah, that's a great point, and not an easy eye of the needle always to thread, right? So good point. Jonathan.
Mike, I just wanted to add, one other thing to think about is, risk management evolves over time, and something that John Bull just mentioned just, reminds me of, risk management and hedge accounting. It's not like taking a picture. It's not static, and it's not as of a point in time. So understanding how it evolves over an economic cycle is just as important to a financial statement user. So I think where the disclosures have lacked to date is the fact that people sort of look at it as very static, and once it's set, it's done. Whereas, if there's a more dynamic way to provide that information to users, I think that could be a tremendous help. So just something to keep in mind.
Right. Yeah, it's a great point. Or said differently, the users may need more information at different times depending on where we are in that cycle as well. All right. Okay. Any other comments, thoughts, questions? Okay. Well, thank you, and a special thank you to the group leaders. I know that was a heavy lift, and I think you did a great job at really bringing out some good points, which hopefully will be helpful to the staff and the board as they go forward. So, thanks everyone for that. So, why don't we move on to the last point of the day here, which is the implementation of recent standards, including crypto assets and the use of resulting information. This is going to be an open discussion, hear how council members feel, implement, and give us input on the implementation experiences with recent standards. we've had sessions in the past as part of the board's post-implementation review of major standards like revenue recognition, leases, CECL. This session is an opportunity to listen to your feedback on other recent standards that have been implemented, focusing on the observation about benefits, costs, operability. As a quick reference, the materials provide a listing of recent standards. So they're using public company effective dates of 24 and 25. The other thing, perhaps to touch on this session, and probably not the last time, but as a follow-up to our September discussion on technology and potentially informed by experience with recently effective accounting standards, I would like to hear any additional observations you have about how technology should be considered by the FASB, specifically how technology could affect future standard setting. So before I get started on that, any observation from board members or staff on this topic? Okay.
I'll just say that we got a great deal of good information. Thank you very much for all the input. It's interesting to see all the consistencies among the groups. So, I think there's some specifics we can work with.
Great. Okay. So then let's move on to the discussion questions on this topic. They're on page 2 of attachment 3. So question 1 really aimed at preparers and practitioners. Do you have any observations about the costs or operability of recent standards that your company or clients have implemented? If you could describe the nature of those costs or operational experiences, such as systems, processes, or applying certain areas of the guidance, that would be helpful. So I'll throw it open to any observations folks have about trying to implement recent standards as a preparer or a practitioner. Matt.
I'll start. Cost of implementation, maybe I'll regret this, but has been on track. So there's a lot underway, but nothing terribly concerning. And maybe this is a little bit technology, Mike, so I'm sorry if I'm cheating, but the segment principle of what's regularly reviewed by CEO, maybe P&G's just slowing the technology curve, but it's getting really tough to really operationalize that. And we're frankly using the word significant more as the secondary criterion than what's regularly reviewed. I don't think we're unique, but we have a corporate data lake. Everyone can access it. You don't need any technical knowledge. You can just literally say Morocco net sales, and the agent interprets that and gives you the information. And so I just worry, if challenged as a collective profession, it's really difficult to kind of navigate. And so at least what we're doing, and Brendan gave me some grace from Deloitte, but we're really focused on the significant, regularly reviewed regularly kind of concept, because I think the genesis of this was when I was younger was, these reporting physical packages, and that's becoming more and more of a ghost in my experience. Nothing to fix right now, but I think maybe just as we think about things in the future, or maybe if practitioners have points of view, it's something we could probably just be more mindful for in the future.
Yeah, I think that's an excellent point. I haven't practiced for a while, but even back in my day, I used to struggle with that one as data became more available. So, interesting point. Other comments from preparers, practitioners about some of these recently standards? Tom.
Maybe I'll echo Matt's points. We've definitely struggled with that as well as the data becomes more and more available to CEOs. Making that cut will become more and more increasingly difficult. So I would agree with that comment. Maybe one I wanted to comment on was the tax disclosures and maybe just give a sense of what we're seeing on that front. I think it's just a very big lift from a data perspective to pull together. And I think it's just been a challenge for many preparers, given that many in their tax groups have been struggling with Pillar 2 and pulling together data for Pillar 2, both from a compliance perspective, but also from a modeling perspective. And so it's just the timing of it has been difficult to manage my general sense is the cost hasn't been huge, but it's like the same individuals are involved in all of those things at once, and it's just been, from a throughput perspective, challenging along the way.
Curious from a user's perspective on that one, not to put you all on the spot, but maybe getting a little bit ahead here. But as it relates to that specific area, the tax area, is that something you're anxiously awaiting to use? Something that really isn't as high on your list of action items, if you will. I don't know how to interpret no comment.
Well, Mike, maybe I'm not an investor, obviously, but yeah, I think some of the sentiment on that income tax disclosure is similar to what Tom just said, is that taxes are very complicated. So, I think it'll be interesting to see how users react to it, is whether those new disclosure requirements is really going to give them a better understanding of the tax profile. There's been some input that because of the disaggregation, there might be sometimes things that in the aggregate were being disclosed, but when you break it out to federal and state and foreign, it'll actually drop below the 5% threshold, and there may be some less visibility in some of the items. So I think it would be interesting to see how investors ultimately react to disclosures and whether there's an ask for additional information in the future.
Okay. All right. Any other recently enacted standards that have caught your eye as you've tried to operationalize them? Adam.
Well, I'll say that, the longer I sit where I sit and then I come to meetings like this, the board does a hard job of balancing a lot of competing demands to come up with standards that produce the information that people rely on. And nobody's got a perfect crystal ball, right? We always learn things after the fact. That's just unavoidable. And so from a process standpoint, things like the agenda consultation that the board does, the post-implementation reviews, and then the one-off agenda requests that come in, I think those are critical, right? Because that's where some of the unintended costs can be identified and addressed. And so the two standards that I have in mind in particular, one is 2020-06 on convertibles. There was just I think a recognition that some of the complexity in the model wasn't helping anyone, users, preparers, nobody. More recently, on the heels of the SPAC craze, people were getting to purchase accounting because of a quirk in the VIE rules, and the board heard that and reacted to it through the EITF. And so both of those two standards, I think, capture what, in my mind, is a really good process to say we didn't necessarily intend to get to the places that we did. And yet there was a willingness to come back and take a look and say, okay, well, let's adjust those. And so I'm just recognizing nobody's perfect on the front end. That backwards looking sort of assessment periodically, I think, is just a key part of the whole system.
Okay, thank you. Other comments about recent standards? Joe.
Yeah, so I'll talk about two that have already been brought up. One, the segments disaggregation, the other, the tax footnote disaggregation, and maybe some how they contrast to each other on the cost to implement. I'm not going to spend a lot of time on operability. I think Matt mentioned some things around regularly reviewed, particularly on the segments piece. But I think what I'd say is, because the segment disclosure was effectively based on internal management reporting, the cost to actually get the data ready for disclosure was almost zero. It was very, very easy to get it ready. And where we spent time, cost to get ready for the disclosure was actually preparing for potential investor questions. So we did a lot of benchmarking of our segments against more pure play competitors for those segments to get ready to explain why our particular line item as a percent of sales for that segment might be more or less than a competitor. We were a bit surprised then, once we disclosed, that we actually received zero questions from our investors about the individual segments' P&L profiles or how they compare to investors. I would contrast then that cost and where we spent the time to where we have been preparing for the tax disclosure, where the tax disclosure is much more structured, as you know, particularly on the rate reconciliation. And our systems, fortunately, were already well suited, partially because of Pillar 2 and other things that we do to manage income tax accounting internally. We're already pretty well suited to be able to come up with the data. Where we've spent a lot of time on this one is not preparing for investor outreach because we're anticipating really no questions about it. Where we've spent a lot of time is on the more unusual transactions, discussing with our auditors, does it go in this bucket or that bucket? And we've already been spending a lot of time on those questions where at the end of the day, we're not really sure the benefit of trying to get to perfection on, whether this transaction should be reported in this line or that line of the rate reconciliation. But that's just where we're spending a lot of time and cost.
Interesting. Thank you. Other comments from preparers or practitioners? Okay, well, let's move to the other side of the coin then. From an investor point of view, user point of view, do you have any observations about the benefits or the effects of implementation of these standards on your analysis for capital allocation decisions? Has the information provided by the recent standard made financial statements more decision useful? If yes, in particular, which areas and why? Yanni.
So I want to speak up with credit, positive credit for the disclosures related with supplier financing programs. I think as a result of that rollout, we've seen a lot more information about supplier financing across lots of industries, and I think investors learned that it was a much more prevalent scheme than had widely been understood, and provides really important information about the real underlying cash flows in certain businesses, which use supplier financing to adjust the timing of outflows to suppliers. So that's been really valuable, I think, in a lot of industries.
Great. Thank you. Shripad.
Yeah, I echo Yoni's remarks on, the implementation has brought to light a lot of companies who are engaged in this. So I think that's definitely very useful from a user perspective. Having said that, I think 2 points I'd make. One is if you look at the kind of disclosures that companies are making, some companies just go and put a sentence in there about we are engaged in this, but it's not material, which is not, again, useful from a user perspective where we are trying to figure out what the impact is. And then the second, I think, point around these disclosures was there's a requirement for key payment terms, but really not. There were lots of companies who, I don't know if they just didn't disclose that or they didn't think it was necessary. So besides just the non-material piece, I think a number of companies haven't disclosed that, which again goes back to the point about we still have to go back into the same work which was required pre-disclosure. So we do have a better sense of companies who are involved with these programs. We do have a better sense of companies about, who to ask questions, but we still need to ask questions unless those disclosures are appropriate. And there are a lot of companies who do good disclosure too around this, but then, it goes on the other side as well. So I think just probably more specificity around requirements versus letting the standard say, I forget the exact wording, but I think that's where the interpretation comes into play.
Okay. Thank you. Any other users with comments on this group of recently enacted standards? All right. If not, let's move on to crypto then. Any observations about the implementation of the accounting and disclosure for crypto assets, including benefits, costs, operability, or other comments? And I'll throw this open to all, recognizing that not all are engaged in this. But How are you all feeling about crypto these days? Other than your portfolio? No comments at all on crypto? It's interesting. Tom.
Yeah, I'll help you out, Mike. I think overall, from an implementation perspective, there wasn't a big cost to figure it out. I think the biggest questions were just around how do you determine fair value and figuring out the principal market and sort of the decisions around that, which can be challenging, particularly when you've got crypto that trades 24 hours a day, and the emergence of new markets over time. And so that's where I think a lot of the questions have been. Fair value and as well as what's in scope, and certain things that aren't in scope. People are wondering why they weren't in scope, which I know is something that the board's going to be looking at. But that's, I think, most of the conversations we're having.
Thank you. Brandon?
I could have probably lowered my hand because Tom covered, most of, I think, what our observations were, including some of the fair value items. But one area, around scope, that I think some companies are very interested in is wrap tokens, which were, deliberately not addressed, but have, a lot of similarities to, a readily available fair value and fungible. And I think there's some interest in additional discussion there. And, so I do think there's, some future standard setting that would be helpful in crypto. But for the most part, companies that were involved in the space, even though the disclosures are very robust, they were already tracking that type of information in their processes already. So I think it's one of the standards that, those companies asked for. And I think the FASB, reacted to that need, and I think it's benefiting them and the users of the financial statements.
Okay.
So that was before my time here, but what I'm hearing is that good job on the team previously. And am I hearing that the right things need to be on the agenda now, given the emerging and continuing to develop market, are on the agenda? I thought that's what I heard.
Yeah, Jack, certainly I think looking at wrap tokens and other instruments as far as whether they should be subject to fair value as well, I think is really important. And it's good to see the board addressing that. There's always been questions around crypto lending and derecognition activities as well, which I think are worthwhile to be looked at as well.
Okay.
Yeah, it's likely to be one of those whack-a-mole situations, right? As the market evolves, I suspect there'll be a series of challenges that come up as new instruments are employed. Any other thoughts on crypto? I think I'm probably not giving away any secrets from Dave, as of he follows me, that I suspect this will be on your agenda in the future and have a chance to go into a deeper dive on this. So you can hold your comments for then. All right. If not, then why don't we just move on to the conclusion of this session here. Thank you. I want to thank James King, our departing PTA. James will be joining Deloitte's Accounting and Controls Reporting and Advisory Group in Houston. As always, thanks for the discussion. The next meeting will be Tuesday, March 10th. We're going to adjourn the public session, but if the council members can remain virtual so that we can take a few minutes to thank the departing council members, that would be great. So to all of you who are listening, thanks for your attention, and that will close this December meeting.